Okay, so it's been a little while since I put out a technical analysis video for many different reasons. So the last time that we were actually talking about Cardano ADA from a technical analysis standpoint, we were looking for a long position and then we were looking to go into a short position. Okay, so from here we can see that we did have this low. We pushed up to our high. Okay, it was an 8.12%. You can see here that this was our take profit hit, and then we looked for a move to the downside. The move to the downside coming in from our short position, as you can kind of see here, currently has dropped down by 6.39%. Now, we were originally looking for us to come down more towards 64.5 cents, but you know, things are changing here ever so slightly when it comes to Cardano. So let's go ahead and review what's going on then from a technical analysis standpoint. But it is going to be incredibly important to remind everyone that obviously I am not a financial advisor. I cannot offer financial advice. All I can do is give you my thoughts and opinions on the data in the charts as I personally see it. So it's just very important that kind of give you the kind of quick disclaimer that I'm not a financial advisor. Nothing in this video is, of course, financial advice. Cryptocurrencies are highly volatile and you could lose all the money that you invest. You should always do your own research and consult a qualified professional. Your investments are, of course, entirely your own responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. This video is for entertainment and educational purposes only. So let's get right into today's video. So good move to the upside. We can go ahead and remove our long position, and we can now focus on our short position that we had here from the earlier in the week, last week. I forget because it's been such a long time with everything that's going on with kind of like the YouTube side of things in terms of like regulations and just like demonetization and videos being deleted by YouTube and all that kind of nonsense. If you're not familiar, you need to jump into the Discord and you can get the lowdown there. But ultimately, we have a pretty interesting move to the downside, right? So as we kind of get into this, well, you can see if we measure this distance initially, okay, this is quite a clear three-wave drop to the downside. Okay, we then move over to here where we have what appears to be more of like a five-wave move. However, I don't think it is. I believe that this is actually still a three-wave pattern masquerading as two five-wave patterns combined. So an ABC, a zigzag pattern if you're familiar. And you can see that this comes down between 1 and 1.236, which is pretty typical of a three-wave move. That means that we're actually looking at a three-wave pattern, okay, coming in here as ABC down, which basically constitutes a W up, and then we have a larger ABC structure with more defined five-wave patterns, basically a double zigzag. Okay, that is really interesting to me because it means that we should probably be expecting a diagonal finishing movement for the fifth wave pattern. Okay, five waves, or the fifth wave within a five-wave pattern, can be so many different things, right? We've got the kind of standard impulsive five-wave contained within, so basically just a 1, 2, 3, 4, 5 structure. Then you've got five-wave structures in what they would call an ending diagonal paced pattern. With that, you would have basically three waves like an ABC structure that basically maps out 5 times over, and you'd still hit 1.618 with your third wave. So basically your zigzag pattern would still hit 1.618, and then you would kind of finish off with the typical kind of five-wave pattern, but it all contains three waves instead of five waves internally. Then you end up with things, other options such as contracting or expanding diagonals as well, and all of which can truncate, which means fall short of their targets. So we have to be quite cautious here. It's very possible that we are tracking multiple different scenarios at this point in time. Specifically, we could be tracking a an expanding diagonal, within here, and it looks like it also has the ability to potentially truncate, falling short of its normal expected ranges. So Cardano is not an easy read, right? So we need to be a little bit cautious with our short. So obviously this is all hypothetical, right? Educational purposes. And what I would be doing would be looking to bring that that stop loss into the green area, right? I would be looking to keep that stop loss following the 200 exponential moving average. That seems to be our major area of resistance. The 50 EMA, 50 SMA, we've broken those a couple of times. So I would probably put this stop loss at this point in time around entry, so break even. And I'll just track this 200 EMA and just have that take profit kind of following down. Now, one of the things that we need to kind of consider if we want it to be super, super safe is how the stop loss in itself can actually be just above this previous high somewhere around here, because the wave 4 would never breach the highs of wave 2. So if we were to track some kind of expanding based diagonal pattern, you know, some kind of 1, 2, kind of 3, the wave 4 is never allowed to cross that wave 2 peak, right? So we could safeguard ourselves this wave for that kind of big kind of final fifth wave move to the downside to complete out that fifth wave pattern. So there's always that as a possible scenario. But of course, you know, for me, I would probably be just looking to do something to this effect. The 200 EMA is the heavy line of resistance. And if our entry is currently above the, below the, it's above the 200 EMA now. So that actually puts us in a bit of a buffer anyway. So we just want to make sure that we protect ourselves just in case this market does what we call truncate and then just reverse on us. We've kind of played the game, you know, the best that we can, essentially, right? Trailing stops are great. Lock in some profits if we have them, all the kind of usual stuff. Now, our kind of typical movements here for Cardano, we would be normally looking for a move between 1.236 and 1.618 on the fib scales, right? So that basically means that our wave 4 here, okay, our wave 5 is going to be 123.6 times or 161.8 times the wave 4 movement. So basically, the higher that wave 4 goes, the lower that wave 5 goes, right? They relate to each other. But when it truncates, the minimum expectation is actually a double bottom with your existing kind of wave 3 lows. That would actually put us at 65.41. So my minimum expectations are going to be 65.41, right? So it might just be at this stage that our stop loss actually, take profit lifts up a little bit here at around 65.14 with our, you know, stop loss at entry here and just trail that 200 EMA. This means that we're going to lock in profits, or we're going to get stopped out and it's going to cost us nothing, right? So kind of mitigating and using risk management to our advantage where possible. Of course, though, this is just purely educational. Okay, so let's see what else we can take a look at, right? I don't like indicators. I much prefer price analysis, Elliott wave being the king in my opinion, but we can see some pretty interesting things here. Okay, so here we have the MACD histogram. I don't like the moving averages, but the histogram just gives us a visual representation of what's going on momentum-wise, which is great, right? We use this as another way to kind of look at the stochastic RSI or RSI. And we'll look at all three of these to see whether or not we have anything major. Now, I mainly use the MACD here, the histogram bars, to look and spot for divergences. Okay, so here we have the price action coming down into lower lows, right? And we have lower highs. And our MACD histogram is pretty much aligned to that. So let me show you, right? So from our trend line here, we have lower lows on the histogram, and we of course have lower lows on the buy-in bars, right? So, or lower highs on the buy-in bars. So basically what this indicates to me is that price action and momentum are pretty much aligned, right? We don't have any major divergences, right? What we can see, of course, is previous times is where we have weakness within the selling, okay? And if we take a look at that, you could see here that there was weakness here, okay, as we were pushing up higher. But again, it wasn't divergence because we didn't see any kind of major divergence here, but the divergence did exist between these two low points. Okay, and this is what the MACD is great for. So here you have lower highs, whilst you had lower highs, you actually had higher lows over here. Okay, so that was divergence that led us into our wave 4, obviously at the low point of the wave 5 anyway. So price analysis is always better in my opinion, but you can use these things to help confirm your movements. So the MACD histogram isn't really giving us any major clues at this stage. We aren't seeing kind of breakout situations, major divergences, anything like that. Turn this off. And we'll bring in the stochastic RSI here. This is our own variation. And this variation basically, let me bring that into view, shows us a multi-time stochastic RSI, right? So we built this one so that we could take a look at the 60-minute, the 240 minutes, the 480, basically the 1 hour chart, the 4 hour chart, the 8 hour chart, the daily, the weekly, and the monthly. What that allows us to do is it allows us to see whether a momentum is overbought, oversold, depending on different timelines, major timelines that I kind of have scoped out in relation to the timeline that we're actually currently looking at. Okay, it's a little bit of a mouthful, but basically what it allows us to do is say, okay, well, we're overbought right here. Okay, we're overbought facing the resistance of a 50 EMA, while simultaneously also predicting that we're coming down to at least 65.41 on this kind of fifth wave movement, potentially even lower down towards 62.33. And so being overbought on the 1 hour time frame aligns with the idea that resistance here is likely to hold. But again, it's just a momentum oscillator. It just shows strength of movements. It doesn't give you any guarantees. The relative strength index is also a very similar indicator, except this one's only 1 step removed, where the stochastic RSI is 2 step removed from the price action. They don't relate to price. They can't predict the length of a price movement, but what they show you is whether or not there's strength in the current move. And right now, the RSI is in weakness because it is below 50, indicating that actually we're in bearish territory. And historically, we've really struggled to kind of get a breakout above the 50 level. Okay, while simultaneously seeing the stochastic RSI in the overbought area, which is more sensitive to the price movements, even though it's 2 steps removed from the price action itself, is an indication that this market is likely to actually see a bit of a shift in the sentiment and the momentum to the downside. No guarantees as how far that goes, but it gives us confirmation. So price action tells us that we have, basically looking for a bit more move to the downside within a 5th wave pattern. We have the resistances of the 50 EMA, 50 SMA, 200 EMA, all kind of suppressing the price action. Simultaneously, we can see that that is backed up by the MACD histograms, indicating that yes, indeed, momentum is indeed bearish. There's no divergences there indicating that there's a subtle kind of bullish vibe going on in the background. The stochastic RSI is also telling us that we're probably going to be looking for another drop. And the relative strength index is also basically saying we're yet to break above 50, and so we are bearish, right? And that's not to say that it's going to stay this way for a very long time. We're on the 1 hour time frame here, right? That means that, for the next kind of 24 hours or so, we should probably be thinking that this isn't going to hold up very well. Okay, so we have our targets set, okay? But these are all just short-term targets. They aren't major targets. They're nothing to be stressed out about, in my humble opinion, at least not yet, because a relief rally, I think, is coming. So let's go ahead and roll this up into a daily time frame. Now, on the daily time frame, we can see that I was looking for a breakout significantly. I was looking for like 93, 94 cents out towards $1, but, and this is the problem, it's possible that we're going to be breaking down into this X wave even deeper, okay, indicating that our W wave is actually up here. And it's probably not even something that I can label up as a WXY at that stage, because it wouldn't really make a lot of sense. You'd basically be looking at this through a very different lens altogether, like a couple of WXYs maybe strung together. It doesn't kind of negate the kind of bullish vibes that we have on a macro scale. All I'm suggesting is that we actually have lower to go before we get that breakout, and that breakout target is going to change. Okay, so what we were looking for, is really going to be hard to see come to fruition now. Okay, so it's just a probability, and it's a lower probability than it was before. With the move to the downside here, specifically if we do lose the 64.26 cent low, then we should be expecting, a bit more of a move towards these kind of previous areas of support, around 60 cents. Once you do that, then of course we'll have a breakout again, potential, a higher probability of one anyway, that will probably be looking more towards 80 to 90 cents rather than 90 to $1, right? So the targets, they change a little bit depending on how low you go. And of course the structure in which changes as well. But one of the things that is really important with the price analysis here is, even if you take all these kind of waves off and you take the trend lines off, because why would you keep those on? They kind of tell us that we have an overlapping nature of candlesticks. Now, the overlapping nature of candlesticks is actually a positive, not a negative. Okay, so it tells us that everything that's going on right now is short-term and not long-term. Okay, trend-based moves, as you can see with this breakout to the upside, there's very little in the way of overlap, right? But when you have these kind of overlapping candlesticks to the downside, it's a very choppy market. And basically, it tells us that buyers and sellers, they're a little bit all over the place. Liquidity is being extracted left, right, and center. And so we can't really look at this market and say, okay, we're clearly trending to the downside, because that's not really what's going on. You have yourself a corrective pattern to the downside. This is mirroring out a WXY, X, and Z based pattern, which is not the best. Now, this move to the downside is a little concerning. If it is correct to be 5-wave pattern, okay, let me draw this into the chart. If I'm right about this, it's a 1, 2, 3, 4, 5-wave pattern like so, and it falls in line with this 5-wave pattern, and then it's possible that this actually nests inside, so you end up with your 1, your 2, your 3, your 4, your 5, and then you start talking about a more of a trend-based pattern on a macro scale to the downside. But again, even that can be wrapped up into something rather interesting. Okay, so you can see here that this pattern itself wouldn't be the worst. You can look at it from a multiple different perspectives. cumulatives as well, where you could end up, we're looking at this through the kind of lens that actually this is a part of a bigger, larger macro corrective pattern that once completes leads us to the next big breakout. Now, if I zoom out far enough, guys, you will note that we've been tracking a cumulative and distribution zones for quite some time. Back in 2022, I was predicting out 22 cents. I actually lost faith in this towards the end of 2022, but eventually we got there in 2023. Okay, this is the problem, right? Price analysis, it's not going to predict time. At least I can't predict time with it. But what I can do is tell you roughly where I think the prices are likely to be going based on the behavior and the sentiment of what's going on in the market. That's basically what Elliott Wave is. It's just tracking people's behavior. So in 2022, we could see 22 cent. We got down to 23. I called that the bottom. I was wrong. It was actually 22. So I was right. And I was wrong about being wrong. You get the idea. Anyway, that being said, after the bottom was in, we found our first distribution event. That was 32 to 38 cents. That led us to our first accumulative zone. This is the one where we could say, okay, the bottom's in, we've had the first distribution, this is where we want to accumulate, 23 to 28 cents. So if you didn't kind of have a buy order randomly placed at 22 cents, you know, and you got lucky that the exchange did indeed wick down there like we were predicting, then, you know, this was going to be the next buy area. That led us into the next distribution event, which was between 57 and 85 cents. Then that led us into the previous cumulative range, which was between 27 and 42 cents. And if anyone remembers that most recently, I was talking about how you should be looking at thinking, you know, dollar cost averaging strategies lower than 42 cents. Of course, not financial advice, purely entertainment and of course, educational purposes. That led us into this fantastic breakout that we had around the US election. Again, lots of reasons why we saw that coming. I'm not going to go into all those details, but I would say you can probably find it, but you can't because of the YouTube, but join the Discord, right? There's lots of details down there. Anyway, from here, we had this kind of breakout move targeting $1.01 to $1.37. I was hopeful that maybe we can get a breakout towards $2.27. We couldn't get past 1.236 on the fib scale, which was a clear indication of our C wave being in. Okay, so when we started to break on down, we mapped out after this distribution event, the next accumulative event, right? Which is 27 to 53.95. We've tapped this range twice before. There's no guarantees that we're done, but there's also no guarantees that we come back down here, right? Because nothing in life is ever going to be guaranteed. I actually was on record a couple of weeks ago, I think, saying that I don't think there's a high probability of us revisiting these lows. So, you know, there's a couple of moves here, and we broke above the 200 EMA, but now we're back below the 200 EMA. I think there's a possible move here that could actually get us back down into the kind of 50 cent ranges for accumulation. But anything can happen, and it's just probability. So looking at this based on the behavior that I see today, there's a possibility that we do tap around 54 cents again into the accumulative range. Now, historically, ADA's spent a fair amount of time down in these accumulative ranges, but there's no guarantees that it does that again. Okay, so I want to be very aware of that. I would say that I think there's a possibility that we do come back down towards 50 cents. And if we do, then that's really the opportunity, right? Right now, even at 67 cents, I don't think it's a bad price, but I do think there's better prices to come in the future. But of course, it's just my own thoughts and opinions, right? And kind of what I'm looking at the data and how I'm interpreting the data, which of course is going to be subjective to how I look at the market. Okay, so, you know, I apply Elliott Wave, which is very much a black and white tool, provided that I don't make any mistakes with that, and it is complicated, but provided I don't make any mistakes, then I'm looking at this thinking, okay, well, we're going to be looking for, you know, dropping down towards 60 cents for support. And if that doesn't hold, then we really should be thinking about 50 cents. And if we do complete a 5-wave pattern like this on the daily time frame, expect a relief rally, maybe up towards 70, 75 cents, hitting the resistances, and then looking to come down, maybe even tapping around kind of these previous lows of 50 cents. So I don't think we're going to be looking for depth within this accumulative range, but I can't rule out not tapping the higher ranges of it again. So it's food for thought, right? Nothing is guaranteed. We're probably talking, you know, weeks before anything actually majorly happens, if it were to happen at all. But as I look at it, it wouldn't be right to do this video and not talk about what I'm seeing inside the data. And I think that's going to wrap up today's video. So if you have found it useful, smash the like button, subscribe if you're new, and I'll catch you all in the next one.